Hello everyone, it's Dan Bodu from Kensington Accounting. We are an online course provider specializing in accounting. This video is part of a series of revision videos for IGCSE and O-Level in accounting. Today we will be reviewing the Cambridge IGCSE Accounting Specimen 2020 Paper 1. Just a quick note of my profile so that you have an idea who is your tutor. We also offer the following courses as shown on your screen. Please visit our website for more details. Now let's go straight to the questions. Paper 1 has 35 questions. We'll be looking at all of them, so please be patient. Now, question 1 essentially is about the distinction between bookkeeping and accounting. Bookkeeping is essentially about recording of financial transactions, whereas accounting is about using the financial records prepared by the bookkeeper to do more complicated tasks like preparing financial statements, analyzing financial data, interpreting financial data, and communicating financial data. Now, based on these definitions, let's go to our questions. Item A is talking about interpreting. Okay, that's accounting, therefore that's an incorrect answer. B, preparation of financial statements, that's also accounting, therefore it's an incorrect answer. Recording of financial transactions, that's okay, that's bookkeeping. D, summarize financial position. Summarizing financial position is very similar to preparation of financial statements. This is a function of accounting, therefore it's an incorrect answer. Therefore the correct answer is C. Question 2. This question is about the definition of assets. So let's look at this definition. Now, assets are items that is owned by the business. Okay, so the keyword is owned by the business or owed to the business. Okay, so it's essentially it has two parts in terms of definition. So it's items that are owned by the business or items that are owed to the business. Now, examples of assets would be cash at bank and cash in hand. Okay, so these are items that are owned by the business. Items of non-current assets like buildings, furniture, motor vehicles, equipment, machinery. Now, these are also items which are owned by the business. Another item which is owned by the business would be inventory. Okay. Now, items which are owed to the business, examples would be trade receivables. Trade receivables, that's another word for trade debtors. It means amount which are owed to the business by credit customers because the business sold goods or inventory to these credit customers on credit, and therefore they owe money to the business. Other types of assets which are owed to the business would be prepaid expenses or deposits paid by the business. So these are money which have been paid by the business in advance or as a deposit. Therefore, third parties would owe money to the business. So these amounts are owed to the business. That's why they are assets. Now, based on the definitions, let's look at the four possible solutions. So item A is talking about items which are bought for long-term use. So here it is only referring to non-current assets, but assets also include current assets like inventory, trade receivables, and prepaid expenses. Therefore, this is not a complete definition of assets. Therefore, the answer is wrong. Item B is talking about cash or items to be turned into cash in the near future. Here it is referring to trade receivables and inventories. Again, it is referring to part of current assets only and not referring to other types of assets like buildings, furniture, and so on. Therefore, this is not a complete definition of asset. Therefore, this is wrong. C is talking about items that are owned by the business, which is correct. But it's also referring to items which are owed by the business. Now, owed by the business, this is a liability. We're looking at owed to the business as an asset, not owed by a business. Owed by a business is a liability. Therefore, this answer is also wrong. Item D, it talks about items that are owned by. So owned by, that's correct, and owed to. Therefore, both these types of items, as per the definition, these are assets. Therefore, this is the correct answer. The answer is D. Question 3. Sami returns goods bought on credit from Javed. How does Javed record in his books? Now, just be careful here. We're looking from the point of view of Javed. Okay. Now, Javed has received the returns because Javed is a supplier. Now, when the supplier receives returns, this is known as return inwards. That's another word for sales return. The double entry for sales return is debit sales return and credit the customer account. Therefore, the correct answer is B. Question 4. At the end of the financial year, there was a debit balance brought down on the office expenses account. In which section of the statement of financial position will this be recorded? Okay, first thing to note, it is an expense, okay, and it's a debit balance. Now, a debit balance is an asset, okay, because a liability is a credit balance. So here we're talking of an asset, okay. Now, because it relates to an expense, it means it is expenses prepaid, and expenses prepaid is a current asset. Therefore, the correct answer is B. Question 5. So we have been provided with a ledger account, a rent account. Okay. The question is, what does the balance on 31st December? So it's referring to this balance, 350. Okay. What is this balance? It refers to rent payable or rent receivable, and whether it is an outstanding or a prepaid amount. So the first thing which we need to decide whether it's this account, it is rent payable. Rent payable is an expense, or it is a rent receivable account. Rent receivable is an income. So first we need to decide whether it is an expense or income. Now there are two ways of knowing this. The first, when we look at this entry of income statement in the rent account, now the double entry for this would be to the debit side of the income statement. Therefore, on the income statement, we'll have an entry, equivalent entry of rent on the debit side. Now, any entry on the debit side of the income statement would be equivalent to an expense. Therefore, this is an expense. Therefore, rent payable, not receivable. Another way of resolving this is when you look at the payment. So the double entry for this particular entry, bank, would be on the credit side of the bank account. Now, only a payment is entered on the credit side of the bank account. And a payment on the bank account represents an expense, isn't it? It's expense which we pay. Okay, therefore it's confirmation that this is an expense account and rent payable. Therefore, C and D are wrong because it's referring to rent receivable. Now, whether it is a prepaid or outstanding. Now, the balance carried down on the credit side, on the debit side, a debit balance carried down represents a credit balance brought down. Okay. Now, a credit balance brought down, it means it is a liability. Liability. Okay, therefore, we're talking about a liability. Now, an expense which is a current liability, it means it is an expense accrued or expense expense outstanding. Therefore, we're talking about rent payable outstanding, because rent payable prepaid is an asset. Now we're talking about a liability here. Therefore, the correct answer is A. Question 6. Karim issued an invoice, a credit note, and a receipt. So this question is about business documents. Now, who issues an invoice, who issues a credit note, and a receipt? It is a supplier. Okay, it is only the supplier who issues an invoice, a credit note, and a receipt, not a customer. The customer only issues one document, which is known as a debit note. Okay, so the customer issues debit note, whereas the supplier issues invoice, credit note, and receipt. Therefore, in this question, Karim is a supplier. Therefore, a supplier sells goods, not purchases goods. Therefore, answer A and B are wrong, because it is referring to Karim purchasing goods. So Karim is not a purchaser. Karim is a seller. Now, very quickly, I have put some literature just to confirm what I have said before. Okay, so A and B is incorrect. Now, item C, it says Karim sold goods, received immediate payment. Now, that's wrong, because Karim issued a credit note. Okay, an issue of credit note, it means the item wasn't paid immediately, it was sold on credit. Okay, therefore this is also wrong. Item D, so it says Karim sold goods on credit. Yeah, received returns, that's referring to the credit note here, the credit note from the customer, and received the balance due later. That's why he issued a receipt. Therefore, this is the correct answer. Therefore, the answer is D. Question 7. A trader purchases on credit for 2,000. This purchase was subject to a trade discount of 10% and also a cash discount of 5% if paid within 30 days. Now, given the purchase was subject to a trade discount, the 2,000 will be subject to a deduction, a trade discount, and a deduction of 10%. Therefore, this is the invoice amount. Okay, 1,800 is the invoice amount. Okay, and only an invoice amount is recorded in the purchase journal. Cash discount is never recorded in the purchase journal. Okay, cash discount is recorded in the cash book, and when it is recorded, only on the date of the payment. And again, the cash discount is given to the customer if the customer pays within the allowed period. That is only on the date of payment and only if paid within the allowed period. And cash discount is never entered in the purchase journal. Therefore, the correct answer is B. Question 8, which is part of the table entry system. Now, a sales journal, okay, and a purchase journal, including a sales returns journal, purchase return journal, and general journal, or pure books of prime entry. They are just a memorandum, okay, of recording information. They do not form part of the double entry system. However, the other two books of prime entry, that is cash book and petty cash book, these have a dual role. They are both a books of prime entry and also ledger accounts. The cash book is ledger account for bank and cash, whereas the petty cash book is a ledger account for petty cash transactions. Therefore, cash book and petty cash book both have a dual role of being a books of prime entry and also a ledger account in the double entry system. Therefore, going back to the question, A, which is part of the double entry system, cash book, yes, okay. General journal, no, it's a pure books of prime entry. So same for sales journal. Now coming to trial balance. The role of trial balance is essentially part of the control system in accounting. And the role of trial balance, it assists in the preparation of financial statements. It also helps in checking the arithmetical accuracy of the double entry system, and also assists in the location of errors, but it is not part of the double entry system. Therefore, the correct answer is A. Question 9. What is a trial balance? So let's look at the definition of a trial balance. A trial balance is a list. Okay, so it is a list. Okay, it's a list of items, and these items we're talking about balances. Okay, not the movements, but the balances, the closing balance. Okay, of this account in the ledger. So the ledger refers both to the general ledger and the subsidiary ledger, that is the sales ledger and the purchase ledger, and fourth, it refers to a certain date or a particular date. So this is the definition of a trial balance. We're talking about a list of balances in the ledger at a certain date. Okay, it therefore includes the balances of all accounts, okay, in the general ledger, and the total of the balances in the sales ledger and purchase ledger. The total of the balances in the sales ledger is represented by trade receivables, and the total of balances in the purchase ledger is represented by trade payables. It also includes balances on the cash book, which is the bank account balance and the cash account balance, and it also includes the balance on the petty cash book, which is the balance on the petty cash account. Therefore, the T to trial balance includes items such as sales, sales returns, income, expenses, provisions, assets, liabilities, capital, and drawings. Now let's go to our question. Item A is talking about a list. It's talking about balances, and it's also talking about particular date, certain date. Therefore, seems to be the correct answer. Item B is talking about a list of assets, liabilities, and capital. So this is wrong because it's not referring to income and expenses, whereas a trial balance also include income and expenses over and above assets, liabilities, and capital. C is talking about a summary of business transactions. Here we're not talking about transactions. Here we're talking about the closing balance, not the transactions, of a particular account, but the closing balance. So for example, in the bank account, we are talking about the closing balance of the bank account, not the summary of transactions in the cash book or bank account or cash account, but we're talking about the closing balance. Therefore, item C is also wrong. D is talking about a summary of financial position. Here it is referring to the statement of financial position, not a trial balance. A trial balance is just a list of balances. Therefore, item D is also wrong. Therefore, the correct answer is A. Question 10. Which error will be revealed by the preparation of a trial balance? Basically, there are 6 errors which are not revealed by a trial balance. I've summarized these and categorized them into 2 sections. POO, POO, and triple C is much easier to remember. P stands for error of principle. So error of principle essentially is a correct amount, correct side, but wrong account and wrong class. For example, purchase of motor vehicle posted to motor vehicle expense account. This will affect both the profit and balance sheet. O stands for error of omission. This is a transaction completely omitted from the books. Okay, second O, it stands for error of original entry. It means the wrong amount entered in the books of prime entry. For example, sales of 167 entered as 176 in the sales journal or sales day book. The triple C, the first C is error of commission. So it's a correct amount, correct side, wrong account in the correct class of accounts. For example, payment of rent posted to insurance account. This will not affect the profit or balance sheet. Second C is complete reversal of error. So the correct amount, correct accounts, but both entered on the wrong side. For example, credit purchase, instead of debiting purchase, is credited to the purchaser's account and debited to the purchase ledger. And the last thing is compensating errors, is two errors cancelling each other, like both the sales journal and the purchase journal undercast. So these are the 6 types of errors which are not revealed by the trial balance. So let's look at the 4 items in our question. Okay, item A, an amount recorded twice as a debit entry. Yes, so I think this seems to be the correct answer. This will be shown as an error in the trial balance. The trial balance will not balance and it will be revealed by the TV. B, a capital expenditure item treated as a revenue expenditure, just like a purchase of motor vehicle posted to the motor vehicle expense account. This is an error of principle and it will not be revealed by the trial balance. Therefore, this is incorrect. This is correct. A double entry made using an incorrect amount. So it's a bit like the error of original entry. Okay, just like here, sales of 167 entered as 176. So this also will not be revealed by the TB. D, a transaction completely omitted. That's an error of omission, and it will not be revealed by the TV. Therefore, the correct answer is A. Question 11. Tracy sold a computer at a net book value for 1,800. So the net book value is 2,000 and the selling price is 1,800. Therefore, it is at a loss. Loss was made. Okay, the payment was received for the sale, but no entries whatsoever were made regarding this particular disposal of a computer. The question is, what is the effect of correcting this error on the statement of financial position? Now, the net effect of the disposal would be first, Tracy received 1,800 in cash, therefore his cash account will go up, right? So debit cash account, okay. The computer account, the net book value was 2,000. It has been disposed. Therefore, the net book value will go down by 2,000. Therefore, the net current asset or computer, okay, the computer account will go down by 2,000. And the difference of 200, it is a loss because Tracy made a loss on this disposal. Therefore, the 200 will be a loss on disposal of computer, which will be a debit entry on the income statement. Therefore, the net effect of this transaction on the statement of a financial position is, first, the cash account will go up by 1,800. Okay. And the net current asset will go down by 2,000. Okay. Obviously, the loss will affect the capital account, but the question doesn't refer to the capital account, so we can ignore that. Therefore, the correct answer is C. Question 12 is about a bank reconciliation statement. So essentially, a business has a bank overdraft. It's a bank overdraft of 1,640. At that date, there were uncredited deposits of 380 and unpresented checks of 460. We need to find the cash book balance on that date. Therefore, we'll need to prepare a bank reconciliation statement at that date. Now, a bank reconciliation statement always starts with the balance per bank statement. It is minus here because it is a bank overdraft. Now, what is an uncredited deposit? An uncredited deposit means a deposit which has been entered in the cash book, but it doesn't yet show it in the bank statement. It does not show in the bank statement. Therefore, for the balance on the bank statement to reconcile to the balance of cash book, this uncredited deposit should be added to the balance per bank statement. Therefore, it is an addition. And unpresented payment or check means a payment which has been entered in the cash book, but it doesn't yet appear on the bank statement. Therefore, for the balance on the bank statement to reconcile with the cash book, this payment must be deducted from the balance per bank statement. Therefore, it is a deduction. Therefore, the closing balance is minus 1,720. Okay, a minus obviously is a credit balance on the cash book, and the amount is 720. Therefore, the correct answer is C. Question 13. What are the sources of information for entries in control accounts? This is fairly simple. All information of entries to control accounts need to come from books of prime entry. That's always. Otherwise, mistakes made elsewhere will be repeated in the control accounts. Yeah. So the students, all they need to remember that all entries in a control account always come from books of prime entry. Therefore, the answer is B. Question 14 is about preparation of a purchase ledger control account. Okay, here we have a template of a typical purchase ledger control account. Let's go item by item. Item 1, that's opening balance. So basically we're talking about movements during a month. Okay, so beginning of the month, 1st of March, the balance is 4,000. Now the balance in a purchase ledger control account, it's a credit because it represents trade payables. It's a liability. Therefore, the opening balance is a credit entry. So during the month, the total purchase journal. Now the total purchase journal represents purchases during the month of March. Now the double entry for purchases. Now we're talking about credit purchases because only credit purchases are entered in the purchase journal, and only credit purchases which are posted to a purchase ledger control account. The double entry for credit purchases is debit purchases and credit the purchase ledger control account. Therefore, it's going to be a credit entry. Purchase return journal total, that's the reverse of purchases. So the double entry is credit purchase returns and debit the purchase ledger control account. That's a debit. Check paid to supplier, that's a payment. A payment, the double entry will be credit as a bank account. Okay, we're talking check here. Yeah, so it's credit bank account and debit the purchase ledger control account. Finally, discounts received. So discount received, the double entry is credit discount received account and debit the purchase ledger control account. Okay. The closing balance, if we just add together, that's 7,000. Okay, and that's the balance brought down for next month. We have some additional templates like interest charge on late payments would increase the amount owed to trade receivables. It's a credit entry. Any refunds by suppliers, also credit entries, the reverse of payments. Yeah, therefore, and eventually the contra entry. A contra entry reduces the amount owed to suppliers, therefore it's the same as payment to suppliers, and it is also a debit entry. In our example, therefore, the answer is 7,000, obviously credit entry, therefore the answer is A. Question 15 is about an error made in posting. So essentially, Ryan bought a computer. A computer is a fixed asset, that is a non-current asset, for $800, and ink cartridges of $50. Now ink cartridges This is an expense. It's a revenue expenditure. It's going to be posted either to computer expenses account or office expenses account. Okay. Now these two amounts were debited to the purchasers account. So we see that's where the mistake happened. Now the correct entry for this transaction would have been to debit the computer account by 800 and debit the expense account by 50 and credit, if it is a payment by check or cash, it would be credited to cash book. If it was on credit, then it will be credited to the supplier account. But here we're not talking about the credit entry. The mistake was on the debit side. So the mistake were item 1 and item 2 on the debit. Instead of debiting computer equipment by 800 and debiting computer expense by $50, Ryan incorrectly entered these two items in the purchasers account. Therefore, the effect of the error is that the purchasers account would be overstated by 850, and the expenses account, instead of debiting 50, there was no entry made. Therefore, the expenses account would be understated by $50. And the computer equipment account obviously has been understated by $800 because no entry was made. Now the question is the effect of the error on this income statement. Now an overstatement of purchases will also overstate cost of sales, because purchase is an addition item in the cost of sales. Therefore, overstatement of purchases, it is equivalent to an overstatement in cost of sales of 850. Okay, and in terms of expenses, it will be understated by $50. Okay, therefore the correct answer is B. Question 16 is about a depreciation method. For which non-current asset is a revaluation method or depreciation most appropriate? Now, the revaluation method is used when it is not practicable or difficult to keep detailed records of certain types of assets. Example would be small items of equipment in the offices or labs, packaging cases, loose tools, also include stationery, and sometimes fuel, for manufacturing businesses or large businesses. So these are the types of fixed assets where the revaluation method is mostly used when it is difficult to keep record, or where it is not practical to have such detailed records. Therefore, in this particular question, the answer would be A, which is loose tools. Question 17 is about depreciation and disposal of a fixed asset. So Amit depreciate his buildings, buildings at 2% per annum. The percentage is quite low because buildings it doesn't lose in value very, very quickly. Normally it is depreciated over 50 years. Therefore, the depreciation rate is only 2%, and it's normally the method of depreciation used for such assets, for buildings, is straight line, because the loss in value is fairly constant over the years. Okay, he bought land for 200,000 and he built a warehouse, and the cost of building the warehouse was 120. After 5 years, he sold the warehouse. Obviously, when he sold the warehouse, it will be inclusive of the land, because obviously building is not a mobile asset where you can sell it on its own. The sale of warehouse would include the building and the land. Now, total cost of the land and buildings will be the cost of the land plus the cost of building the warehouse. Total is 320. Obviously, land is never depreciated. It is only the building, because the land doesn't really lose in value. It's only the building which loses in value due to decay, and it is depreciated. Okay, it's using straight line method. Now the depreciation per year will be 2% times 120,000. For 5 years, it will be times 5 because it is using straight line method. Therefore, the total depreciation or accumulated depreciation for 5 years is 12,000. Therefore, the net book value of the land and buildings will be, the net book value is cost minus accumulated depreciation. Total cost is 320. Accumulated depreciation for 5 years is 12,000. Therefore, the net book value is 308. The warehouse was sold for 299. Therefore, it was sold for less than the net book value. When the disposal proceeds or proceeds from disposal is less than net book value, it means the asset has been sold at a loss. Therefore, this 9,000 is a loss, which is 299 minus 308. Therefore, we're talking a loss of 9,000. Therefore, the answer is A. Question 18 is about accrued expenses. Why should accrued expenses be shown in the financial statements? So we're talking about accrued expenses and why it need to be shown in the financial statements. Let's look at the definition of accrued expenses. Accrued expenses are amounts owed by the business. So it is amount owed by the business, and therefore it is a liability. It is also a current liability because these amounts are due within the next 12 months. And obviously all current liabilities need to be shown in the statement of financial position. Now the matching principle also requires that any accrued expenses or accrued prepayments needs to be adjusted to the expenses account, so that the only expenses incurred during the year are shown, irrespective of what amount was paid, because income earned during the year should be matched by expenses incurred in that particular year. Now, going back to our 4 possible solutions, A is referring to current assets. Okay, here we're talking about current liability, therefore this is wrong. Okay, item B, it says total income of a period should be matched against total cost of that period. That's correct, that's matching principle. C, to show how much customers owe the business. Now, how much customer owes the business is known as trade receivables. Okay, it's got nothing to do with accrued expenses. Well, that's wrong. And D, to show the amount owed to credit suppliers. Amount owed to credit suppliers are known as trade payables. Again, nothing to do with accrued expenses. Therefore, the correct answer is B. Number 19 is about irrecoverable debt. A trader sold goods to Zahid on credit. Zahid was unable to pay the amount owing, and the balance on his account was written off. Which entries will the trader make to write off this irrecoverable debt? The double entry is very simple. It's debit irrecoverable debts and credit customer account. Therefore, the answer is B. Question 20 is about provision for doubtful debts. Now, a quick recap of the accounting entries for provision for doubtful debts. Now, number 1, on the first year, on the creation, okay, when a business creates a provision for doubtful debts for the first time, the entry is debit income statement and credit a provision for doubtful debts account by the full amount, because it is the first year. There's no change in the first year. In the second year, if there's an increase, then the entry should be a debit income statement and credit a provision for doubtful debts, because an increase means the increase in provision is increasing. Therefore, it is a possible increase in the loss. That's why it is debited to the income statement. Otherwise, if the provision for doubtful debts it has in fact a decrease, it means it's a decrease in the provision, therefore a decrease in loss. A decrease in loss is equivalent to a gain. That's why it is credited to income statement and debited to the provision for doubtful debts. Now coming back to our question, so in the beginning the business has an opening balance of 175, which is 5% of trade receivables of 3,500, and at the end of the year it says the income statement was debited. Now because the income statement was debited, it means the company is making provision for additional loss, therefore the balance has increased. Okay, now in the beginning it was 175, therefore it was increased by 15, therefore the closing balance should be 175 plus 15, that is 190. Now if the closing balance is 190 at 5%, therefore the trade receivables, by solving the equation, should be 190, yeah, 190 divided by 5%, therefore the closing trade receivables at the end of the year should be 3,800, therefore the answer is D. Question 21. Which group contains only trading businesses? Now trading means buying and selling, that's what a trade is about. A service company, a company which offers services, is not buying and selling any goods, it's just offering a services. Okay, therefore a service company is not considered as a trading business. A trading business is about buying and selling of goods. Now a driving school, okay, it doesn't buy or sell a good, it simply offers a service of driving from the driving instructor. An insurance agency doesn't buy or sell anything, it simply offer advice and sell insurance products. The same for repairs business, it's not selling a good, it's just offering a service of repairs, and therefore these businesses are not considered as a trading business because they are not buying or selling a good, they're rather service providers. Okay. In the contrary, a petrol station, it buys and sells petrol and diesel, therefore this is a trading business. The same for motor parts, it is buying and selling motor parts. The same for a car dealership, it is buying and selling cars. Therefore these are examples of trading business. Okay. Now going back to our question, A, driving school, no. Driving school, no. Okay, vehicle repairs, no. Motor parts shop, yes. Petrol station, yes. Car dealership, yes. So the correct answer is D. Question 22, that's very straightforward. Which statement is correct? Revenue, that's another word for sales. Okay. Now we know cost of goods sold or cost of sales plus gross profit is equal to revenue minus sales return. Therefore, cost of goods sold plus profit plus sales return is equal to revenue. Therefore, the correct answer is D. Question 23 is about the definition of capital employed. Okay, capital employed. Now, capital employed is equal to equity plus non-current liabilities. Equity, that's another word for owner's capital. Okay. Another way of calculating capital employed is taking total assets less current liabilities. Both are part of the accounting equation. Now, going back to our question, therefore the answer is C. Question 24 is about appropriation account of a partnership. Now there are only 4 items which goes into an appropriation account. That's interest on capital, okay, interest on drawings, salary, and then the remaining profit or loss is shared between the partners. So these are the only 4 items which goes to the appropriation account. Interest on loan, is debited in the income statement, then it is credited to the current account, therefore it does not appear in the appropriation account. And drawings, of course, it goes straight to the current account in the balance sheet. It has got nothing to do with the appropriation account. Therefore, going back to our question, we're talking drawings, okay, drawings here and drawings here, therefore D and B are incorrect. Interest loan here, that's also incorrect. Therefore, the only remaining answer is A, interest on capital. Correct. Therefore, the answer is A. Question 25 is about appropriation account in a partnership. So we know that Mina and Khan are in partnership, which is share profit and losses equally. Okay. And interest on capital is 5%. Okay. We have the balances on the capital accounts and we have the profit for the year. We know that there is no salary and there are no interest on drawings. Now the appropriation account will work as follows. The interest on capital for each partner. So for Mina it will be 5% of 10,000, that's 500. And for Khan it will be 5% of 20,000, which is 1,000. Therefore the total interest on capital is 1,500. The residual profit to be shared between the partners will be the total profit minus the interest, total interest on capital, which is 28 minus 1,500, that's 26,500. So this is known as the residual profit, okay, which needs to be shared equally as stated between the partners. Therefore, each will get half, 30,250. But the question is about how much Mina will get at the end of the year. So Mina will get the 500 of interest on capital plus the share of profit of 13,250, total 13,750. Therefore, the correct answer is B. Question 26, we need to calculate equity for a company. Now, equity, the definition of equity is share capital plus retained earnings plus general reserve balance. Okay, debentures is a liability. Okay, in fact, it's a long-term liability or non-current liability, and therefore not part of equity. Therefore, equity will be 200,000, which is issued and paid up share capital, plus 15,000 of retained earnings, plus 30,000 of general reserve, which is 245. Therefore, the answer is C. Question 27 is about movements in the retained earnings account. So at the beginning of the year, the company had retained earnings of 45,000. Okay, at the end of the year, the retained earnings was 75,000. Profit for the year was 80,000, and we need to calculate the total dividend paid during the year. Now the formula is as follows. Closing retained earnings is obtained by adding opening retained earnings plus profit for the year less any transfer to general reserve less total dividend paid during the year. Now closing retained earnings is 75,000. Opening retained earnings is 45,000. Profit for the year is 80,000. There were no transfer to general reserve, and dividend is a balancing item which we need to calculate. Now, solving the equation, we calculate dividend paid during the year, total dividend paid during the year as 50,000. Therefore, the answer is D. Question 28 is about income and expenditure account for a club. Okay, we take note as the company has receipts, payments, a depreciation charge for the year, and accumulated fund at year end, that's closing accumulated fund. We also take note that there were no accruals or prepayments, and also there were no capital expenditure or capital receipt. Now, what that mean when there's no capital expenditure? It means all the payments related to revenue expenditure, and therefore can be charged to the income and expenditure account. And also because there were no accruals or prepayments relating to these expenses or expenditure, therefore all the payments related to expenditure which were incurred during the year. Second, for the receipts, because there were no capital receipt, it means all the receipts above related to revenue receipts, and also because there were no accruals or prepayments relating to receipts, therefore all this receipts amount were actually revenue income which were earned during the year. Now, because there was also depreciation, okay, total expenses will be the payments of 20,000 plus the depreciation for the year. So therefore total expenses or expenditure is 21,250. Therefore the surplus of income over expenditure is income minus expenses. Income would be 21,600. Total expenses would be 21,250. Therefore the surplus for the year is 350. Now the closing accumulated fund is equal to opening accumulated fund plus the surplus. Okay, closing we know is 15,800 as per the question above. Surplus is 350. Therefore, solving this equation, opening accumulated fund is 15,450. Therefore, the answer is C. Question 29. A club provided the following info at the end of its financial year: rent of premises paid in advance and outstanding subscription from members. Now, rent paid in advance is also known as prepaid expense, and it is therefore a current asset. That's very straightforward, that's very basic. Outstanding subscription from members, it means subscription owed to the business, also known as outstanding income. Because these are subscriptions which are owed by members to the club, it is also a current asset. It is a current asset because these money are due soon and within the next 12 months. Therefore, both items are current assets. Therefore, the answer is A. Question 30. What is an indirect cost? Okay, let's look at some definitions in a manufacturing account. Now, in a manufacturing account, prime cost comprises of cost of direct materials used plus direct wages plus direct expenses. Within the cost of material consumed, we have opening and closing inventory of raw materials. We also have purchases of raw materials, and we also have carriage, which is carriage inwards on the purchases of raw materials. Direct wages, these are wages paid for machine operators, okay, workers which are directly involved in the production of goods. And direct expenses, some examples would be royalties and hire of specific machines for production. For factory overheads, that would include indirect wages, for example, wages or salaries of supervisors. Okay, it would also include factory insurance, rent and rates of the factory, general expenses to do with factory, depreciation of machinery. And then we have work in progress, we have opening inventory and closing inventory. Now, based on these items, let's look at the four possible solutions in the question of what is an indirect cost. Now, carriage inwards, okay, carriage inwards, it's here. It is part of cost of materials consumed, and it is part of prime cost, and therefore it is not an indirect cost. Factory rent, yeah, factory rent is part of factory overheads, also known as indirect cost. So this is a good answer. Production material, That's a cost of materials consumed. It is a prime cost and not an indirect cost. Same for production of wages. This is a direct cost and part of prime cost, and therefore it is not an indirect cost. Therefore the correct answer is B. Question 31 is about movements in the capital account of a trader, and it is also about accounting equation. Now we have given opening capital, okay, then we have been given assets and liabilities during the year, and also drawings for the year, and we need to calculate what is the profit for the year. Now accounting equation, we know that capital or equity is assets minus liabilities. Now in this case we have the figures for year end, therefore we're talking about closing capital. Okay, closing capital is assets, total assets minus total liabilities. Therefore closing capital is 38,500. Now we also know that movements in the capital account, we obtain closing capital by adding to opening capital profit for the year less drawings for the year. Therefore we have a closing capital of 38,500. We have been also given opening capital, which is 25,000 of profit. We need to solve the equation, and drawings for the year, which is a deduction, it is 7,500. Now solving the equation, P, which is profit, is 21,000. Therefore the answer is D. Question 32 is about ratios. So we have been provided figures for revenue, purchases, and gross profit as a percentage of cost of sales. Now gross profit as a percentage of cost of sales is another name for markup, because markup is gross profit divided by cost of sales times 100 in percentage. Now a quick recap. If markup is X divided by Y, then gross margin is X divided by X plus Y. And if gross margin is X divided by Z, then markup is X divided by Z minus X. And markup is always higher than the gross margin as a fraction or as a percentage. Now coming back to our question, markup is 25%, that is quarter in fraction, and gross margin using the formula above will be equal to 1/5. Now the definition of gross margin is gross profit divided by revenue. Therefore gross profit is gross margin times revenue. So we have a gross margin, which is 1/5. We have a revenue, which is 189,000. Therefore gross profit will be equal to 37,800. Now you would notice that the figures for purchase was irrelevant and not needed to reply to this question. Okay, therefore the correct answer is B. Question 33 is about ratios again. Therefore we have the rate of inventory turnover, which is 10 times. We have opening and closing inventory, and we've been asked to find the figure for purchases for the year. Now the formula for rate of inventory is cost of sales divided by average inventory. Okay, and average inventory would be equal to the opening inventory plus closing inventory divided by 2, which is 900. Okay, therefore cost of sales will be equal to average inventory times the rate of inventory turnover. The average inventory is 900. The rate of inventory turnover is given is 10. Therefore cost of sales is 9,000. Now we know cost of sales is equal to opening inventory plus purchases less closing inventory. Cost of sales is 9,000. Opening inventory is 800. Closing inventory, that's 1000. Purchases is a balancing figure. Solving the equation, P or purchases is equal to 9200. Therefore, the correct answer is C. Question 34 is about accounting principles, and we have been asked what is the definition of going concern principle. So let's look at its definition. Now, the going concern principle assumes that the business will continue for the foreseeable future, in fact for an indefinite period, and it has no intention of closing down the business or to reduce the size of the business by any significant amount. Therefore, the accounting records are maintained on the principle of continuity. Now, looking at item A, possible solution, accounting records are prepared assuming that the business will continue to operate in the foreseeable future. This is the correct definition of going concern. Item B, income and expenses should be accounted for in the same way they were accounted for in previous periods. This is consistency principle, which requires that once an accounting policy has been chosen, it must be applied consistently year after year so that the financial statements can be compared between various years to measure performance and trends in the business. Therefore, answer B is consistency and is not the correct answer. Item C, profits should not be anticipated and losses should be written off as soon as they are known. This is prudence principle. Prudence principle requires, as mentioned in the question, that no profit should be anticipated, and as soon as losses are known, they should be booked and expensed in the current year income statement. Therefore, this is also not the correct answer. And D, revenue and costs should be recognized as they are earned or incurred, not when money is received or paid. Obviously, that's matching principle, which requires that revenue should be stated in the income statement when on an earned basis, not on a receipt basis, and expenses are charged to the income statement on an incurred basis, not on a payment basis. Therefore, answer D is also wrong. Therefore, the correct answer is A. Question 35 is about accounting objectives. Essentially, the quality of information, the quality of information contained in financial statements are very important because it determines the usefulness of these statements. And the quality of information are measured using these four factors. Therefore, these four factors affect the quality of information. These four factors are also known as accounting objectives. Now, very quickly, let's look at the main definitions of these four terms. Comparability, essentially, we are talking about financial information could be compared for the same business, so comparison of financial information for the same business for different accounting periods, or comparing similar information for different types of businesses. And essentially it helps users to identify similarities and differences between financial statements so that they have a better understanding of changes in the financial statements for the same business and also between different businesses. Relevance, essentially, we're talking about information should be provided on a timely basis, and the information provided should be relevant, because very often information contained in the financial statements are the basis of financial decisions. Okay, therefore information should be relevant and timely, because these financial statements are often used by users to make financial decisions. Reliability means the financial statement should be reliable, okay, and should represent a true representation of the transactions and the events, okay. They must be independently verifiable, okay. They should be free from bias, free from significant errors, and suitable caution has been used for judgments and estimates when preparing these financial statements. Lastly, for understandability, the information provided in the financial statements should be such or presented in such a way so that it could be easily understood by the users. The information should have clarity, okay. And lastly, simply because some information are difficult to understand doesn't mean it should be omitted because of its difficulty. Now, based on these definitions, going back to our question, which accounting objective is being applied when financial information affects business decision? So business decision, obviously here, business decision, we're talking about relevance, okay. Therefore the answer is B. Dear students, I sincerely hope that you enjoyed this video. I certainly did, and that it will help you in your revision. If you did like the video, please give it a thumbs up, and please subscribe to my channel. For your information, I'll be posting some more videos in the days to come. See you soon, and good luck in your exam. Cheers.